Good morning, everybody. Thanks for taking the time to join us today. My name's Matt Brennan. I head up the passive team at Bell Investments, and I'm here today to talk about the wonderful subject of ETFs. So we all know that 2020 has been a very interesting year for the markets. And I guess ETFs, which have been around since the late 80s, everyone's talked about needing this big test to see how they'll perform and if they really are the structure that everyone thinks they are. So today we're going to talk about how ETFs have performed in 2020s, the positives, the negatives, and any learnings we can take from what's happened. So we're going to cover today the performance. So I guess that's always the bit that people are always interested about, how ETFs have performed, how passive has performed against active, and if there's been any pockets of the market where one has been better than the other. The second part is flows. So we've seen in general large outflows out of equities this year, particularly in active funds. So talk about if those trends have also been seen in ETFs. So as well as performance and flows, one of the important things of ETFs is how they function, how easy they are to trade, the cost of trading. So we'll talk a little bit around that. And then finally, any lessons. So anything at Bell that we've taken away when we think about using ETFs, given what's happened this year. So before I get into the meat of the presentation, just a little bit of a reminder on Bell Investments. So Bell Investments was launched back towards the end of 2016, really to build and manage investment solutions, primarily for use on the Bell platform. In that time, we've gone through the 800 million mark, so really good growth in assets, and we've really expanded our range, as well as the passive funds and the passive MPS, which my team runs. We have an active version, we have a blended version, aptly known as the Pactive range, and finally, and given the push from the regulator towards retirement solutions, we've launched our retirement portfolio service. So let's start with performance. So I think ETFs have really seen a meteoric rise since the financial crisis, and since the financial crisis, the markets have just been one direction, which is mainly upwards. What people have always said is yes, but think about how active will perform on the way down. When markets are all over the place, when you've got those double-digit drawdowns, it really should have been a once-in-a-decade opportunity for active managers to deliver excess returns, protect on the downside, and pick out those winners. So we saw volatility up above or close to those levels of the global financial crisis. So the dispersion between stocks was large, and that's really should be the pickings of an active manager. Alongside that volatility or stock dispersion, active managers, in particular in equity funds, tend to hold small cash buffers. So obviously, if you're holding cash buffers and the markets are down 20–30%, then that cash should protect. On the other side, when we look at active fixed income funds, certainly on the corporate bond side, they typically actually take more risk than a typical passive fund. So they tend to go down the curve when it comes to credit quality. So quite often, obviously, they see extra returns from that area, and they'll often take less liquid positions. So passive fixed income investments always have to have minimum liquidity requirements, whereas an active manager is able to buy into some of these smaller issues. The interesting thing is despite what should have been, I guess, a positive market for equity managers, active equity managers, and maybe something that would be a bit more neutral for fixed income managers, there wasn't actually significant outperformance in the first 6 months of the year. There were small pockets in certain areas, but in general, there was still underperformance. So this work here is from Morningstar. So Morningstar produce what is known as their active versus passive barometer. And here they look at the actual performance of active funds compared to the actual performance of passive funds. So it's not against an index, it's after fee passive versus after fee active. And the red bar is the percentage of active funds outperforming the passive funds, and obviously the grey bar is the passive funds outperforming the active funds. So typically, if that's above 50%, that means more active funds are outperforming passive, and obviously vice versa for when it's less than 50. And you can see, with the exception of UK mid-cap companies, or mid-cap funds, typically the active funds in general have had a hit rate of less than 50%. So despite all this volatility, despite all these market moves, and despite those cash buffers, the active funds have still underperformed the passive space. As you say, this varies from area to area, and certainly on the bond side. So if we look at the bottom three there, of global bonds, US bonds and Euro bonds, the hit rate is actually only around a quarter of funds outperforming the benchmark. And although close to 50%, active managers still in aggregate underperformed. I guess one area that is worth picking out is UK mid-cap. A significant number of active managers actually outperformed, close to 2/3. And I guess that's the point where it is a really sort of niche market, small cap market, very different types of company, driven by different things, international, domestic companies. That certainly was an environment for active managers, but in the large cap space and in the bond space, certainly no significant outperformance by active managers. This is the same data, but rather than being over the 6-month period, the last data was over. This is over a full decade, and I think that's the important thing. Is the big criticism of ETFs was, well, it's been a great decade. The markets have gone up. It's been a bull market for near 10 years, and you can see here in that environment, passive does really well, low costs, narrowly led market by a few big companies. So obviously that's a long term, but the fact that in the short term passive's also done well, I think starts to debunk some of the myths we hear about active managers really being able to protect on the way down in most markets. So let's move on from talking about performance and let's talk about flows. I guess flows are a general indication in terms of the growing confidence in the use of ETFs is probably point one. And then the second point is how people are using the product tactically versus strategically. So I think ETFs, they've had a fairly bad name. And I think if you think about it, it's in the industry's best interest to give them a bad name. They're an upstart, they're low fee, and they're disrupting the market in the sense that a lot of flow is moving from these traditional active funds into these passive space. So here we have some data which looks at the flows into the main asset classes, so equity, bonds, and commodities, and we split this between passive and active. And we can see through to the end of May 2020, so just after the markets had bottomed out and started to recover, you can see really strong flow, in particular into equities and bonds when it comes to the passive side. Commodities have also seen large growth, but that's from a much smaller base. But if we look at equities and bonds, I think it's a really interesting story that despite the volatility and despite the fact that you'd think people would want to move more into active funds, given that kind of historic view that that active managers were the ones to protect on the way down, there was actually stronger growth into both equities and bonds when it came to passive investments. We saw a very small outflow of ETFs when it got really bad in March 2020, but every other month, despite the volatility, we saw inflows into ETFs. I think the interesting thing here is when we think about how the market's performed. So, for example, year to date, we've seen the NASDAQ, which is a measure of technology stocks, or mainly technology stocks in the US, outperforming the FTSE 100 by over 40%. So really, it's less about picking out which stocks are going to do well and more which parts of the markets are winners and losers. ETFs have really provided a good tool to allow you to do this in a low cost, quick way. So you can quickly buy or sell an ETF to target very specific parts of the market. Whereas obviously active funds tend to be a bit more broader, tend to be diversified across sectors and styles. So I think ETFs, again, have proved to be a really useful tool in volatile markets to gain quick exposure, and I think the flows really highlight that. So if performance has been good and flows have been good, I guess the question is has there been any issues? Has there been anything under the hood? How expensive has it been to trade ETFs, and have they distorted the markets? So I think there was certainly one particular area of the ETF market that did see strange things happening, and that was really around the corporate bond market and high yield bond market within ETFs. So here on screen we have the discount that the iShares UK corporate bond ETF traded at. So by discount, when it comes to an ETF, we look at the benchmark. So the benchmark will be a collection of bonds, and those bonds will get marked by a provider. So that might be Bloomberg, or it might be Market, which is also another leading bond pricing provider. We then look at how the ETF is priced, and that might actually be at a premium or discount to that benchmark. So if it's at a premium, that means people are willing to buy the ETF at more than it's been marked at. And if it's been marked at a discount, that means people are only willing to buy it at a much lower price. So we saw here, as an example, at the worst part of the crisis in March, corporate bond ETFs were trading at discounts of up to 7% versus the fair value. So this would actually point to ETFs not working very well. You go, well, actually, there's always been this point that they're always meant to trade close to their fair value. And that discount did lead to headlines that were fairly negative, talking about fears for bond ETFs, mismatches, teetering on the brink, all this kind of fear language. It's interesting that when this happened, there's been a lot of sort of looking as to what caused it. So here we have 3 lines, and apologies because 2 of the lines are actually almost on top of each other. So we have the red line, which is the fair value of the ETF based on the ETF net asset values. That's when the accountant will mark what the ETF is worth, and importantly, they base that on the benchmark pricing. So you can see when the fund is based on those benchmark pricing for the bonds, it actually tracks the benchmark, which is the grey line, really closely. However, the black line is the price of the ETF. That's the price it trades on the stock exchange, and as we touched on, that might be at a premium or discount to what's the perceived fair value. So what does that mean, and why did the price deviate so much away from those perceived fair values? But I think the simple answer is the benchmark was wrong. When you look at the bond market, and particularly the corporate bond market, actually a really, really small part of the bond market actually trades. So here we have some stats from BlackRock. So BlackRock looked at the US corporate bond market. So a very similar thing happened there as the UK corporate bond market, where the products were trading at a big discount. And what they looked at was the underlying bonds in these benchmarks. And what they found is typically only 50% of the bonds in that benchmark actually traded less than 5 times a day. So that means that half the universe of those bonds actually only traded a handful of times. So how do you establish what the fair price of those bonds is when they're not trading? So what you'd find is these benchmark providers would have these calculations that tended to break down, tended to not work properly. On the other hand, the ETF itself traded 1,000 times a day, so over 200 times more than half of those underlying bonds in the universe. So the argument is actually the ETF was a much fairer price for where those bonds would trade if they were actually trading. So the point here is the ETF is actually providing a good price discovery tool. It's allowing you to see where the bonds would actually trade if they were trading. You can use this ETF to get quick exposure to those bonds, whereas actually the underlying bonds are really hard to buy and sell. So although I guess we would say there we explain the discounts as being down to the issues with the benchmark pricing, we still think it's a problem that does need looking into, but more from the benchmark side rather than the ETF side. So let's move on to I guess ETF trading. So one of the reasons I really like ETFs is the ability to trade ETFs both on the primary market, which we'll talk about, and the secondary market. So the primary market is when you trade the ETF like you would any traditional fund, where essentially, you want to buy ETF shares, the ETF manager gets your money, and then in exchange, they buy either shares or bonds. It's much more complex than that, but in simple terms, that's what happens. On the other side, you might want to buy some ETF shares, and on the secondary market, you don't need to speak to the fund manager at all. You can go directly to another ETF investor who already holds those shares, and you can just buy your shares off him. So in this instance, actually, nothing's happening at the underlying fund level. You're trading directly with another investor, and therefore no securities are actually having to be bought or sold. Again, a little bit of a simplification, so please don't kind of pick me up on the technical issues there, but in simple terms, that's the difference between primary and secondary trading. The point here is when it comes to stressed markets, that secondary liquidity or secondary trading is a really important feature for ETFs, because what it means is that an investor can get in and out of its position without actually affecting the underlying markets, because no underlying equities or bonds are sold. So in January, when the markets were functioning normally, you can see that in some asset classes, almost all the volume was being done secondary, 80 to 90% of the volume, and in bond asset classes, roughly about half would be done on the secondary market and half on the primary market. And that secondary market is really producing a release valve and stopping sort of, I guess, underlying positions having to trade. As we move into March, yes, it's true that more of the volume did move on to the primary market. So ETF trading did mean that more underlying bonds and shares were being sold. But I think the interesting part here is that despite that heightened sort of trading, the majority of it was still done on the secondary market, especially for equity classes. So the point here is that people talk about how ETFs are distorting the underlying markets. It's ETF trading that's actually driving share prices higher or lower and flow that's causing that. I would counter this and say, it's not actually the case. There was actually a study from Vanguard that showed if you were to look at US equity trading, actually only about 5% of daily US equity trading comes from ETFs. And actually a much bigger part of it is from active managers or index funds. And we looked at this on the fixed income side, and we found that if you took all the passive corporate bond ETFs and looked at the trading in those and calculated what that volume was, if you just took 2 or 3 of the biggest active funds, the likes of Fidelity and 24, their trading during the crisis and the amount of bonds they had to sell was actually much more than the ETF managers faced. So when it comes to liquidity, it's actually sometimes a bigger problem for the active managers, where they have no choice but to go and buy and sell those underlying shares, versus the ETFs, where they're able to rely on that secondary buffer. I guess the final sort of point I want to talk about when it comes to trading is the cost of trading. So when it comes to trading ETFs, I think the interesting thing is that it tends to be cheaper than buying the underlying securities. Why is that? So first of all, if we go back to the fact that there's primary and secondary trading. So when you trade those ETFs on the primary market, so directly with the ETF manager, then of course they're going to have to go and buy the underlying securities, and they're going to pay the same trading fees as you would if you went to buy those. On the other hand, when that ETF trades on the secondary market, it's actually not the same level of trading fees incurred. So for example, in the UK, when you buy a UK share, you end up paying stamp duty of around 0.5%. Whereas when you buy a UK-based ETF, a UK equity-based ETF, that stamp duty doesn't have to be paid if it's a secondary transaction. So typically this means that ETF spreads are tighter than the underlying spreads of the individual securities. What happened in the crisis is, and we've got a week-by-week summary of a US equity tracker, again provided by BlackRock, is we can see that all times, the spread of that ETF remained inside that of the underlying basket of US equities. Now, it's also true to say that the cost went up. So when the underlying cost of the securities goes up, the trading of that ETF also goes up. So it's not always going to be low, but versus the cost of trading the underlying, our experience during the crisis was it did provide a cheaper cost route into the markets. I think the important thing here is you still need to make sure you look, though, because at the height of the crisis, US Treasury spreads, which you'd kind of think would be a really low risk investment, spiked out to 1-2%. So the ETF spreads also spiked out, just less than the underlying. So don't just buy them without checking, but an ETF can offer that sort of slightly tighter dealing fee. So hopefully that wasn't information overload. Kind of obviously covered the main areas there, which is obviously performance, flows, and trading of the ETFs. It was a really interesting time in the first 6 months, seeing how those areas performed. And I guess we've taken some key takeaways that I'd like to share with you. So I think first of all, ETFs have definitely been a useful tool during volatility. The fact now that there's over 1,500 different ETFs on the London Stock Exchange with very specific uses, technology, consumer staples, emerging market debt, all these different things you can do and provide a really good tool for getting in and out of markets for liquidity purposes and for gaining quick market exposure. Again, we don't think ETFs are suitable for all markets. So as you can see from the performance point of view, stuff like UK small cap, we think, actually it still makes sense to use active managers. But in general, we think passive works well in most parts of the market. Number two, ETFs are not perfect. They functioned well, but when we talk about things like these discounts and spreads going wider, it's still really important not to just point and click when it comes to buying ETFs. It's really important still to make sure you look at what you're buying, where it's trading, where the spreads are, because obviously they can all move around. The market structure means that you should always get a fair price, but actually sometimes it makes better sense to hold off a day or a week when market conditions are a bit better. As I've touched on, active investments still performed well in some areas, in particular in mid-cap equities. So ETFs are not always the best solution in every single asset class. I think when it comes to building a broad exposure, ETFs are fantastic. But if you do want to get into specific areas and those kind of low liquid niche areas, active funds, investment trusts are often a better solution. And despite all this market volatility, despite all the myths, despite all the bad press that ETFs got over the last decade, I think the fact that there's been continued growth into the asset class shows growing confidence. People are happier to use them. They understand how they work. They can see that they do what they say on the tin. I think the growth of ESG, for example, and the amount of money that's going into ESG ETFs shows that new money continues to flow into the space. So, at AJ Bell, we're highly confident about the use of ETFs. But I think the fact that they're growing so rapidly elsewhere and by other participants in the market shows that we're not the only ones that continue to embrace them. And this is why, really, in our passive MPS and passive funds, ETFs are our preferred vehicle. We think they are a better tool, much more easy to trade, much more easy to see where they're pricing. So it gives you a more real-time view of where your portfolio is at. So I think that just about wraps up everything I wanted to talk about today. Thanks very much for taking the time to listen, and I hope everyone's learned something. And if you do have any questions, do feel free to send them in. Thank you very much.